Hello, this is Howie, and I'm here to help you win with money. In this episode of Back to School Level 101, does dividend matter? So I'm going to create a video explaining this, and this will try to answer the big debate. So in the investing world, there's generally two extremes. Do you invest in a stock without a dividend or with a dividend? And I'm going to try to give you both sides of it, because this way you can see the different viewpoints. So before we begin, what is a dividend? Generally speaking, it's just a payment from a corporation to each of the shareholders, and it's usually from the profit of running the business. Now, there are times where sometimes a company may not go into a profit, but they already stated a dividend that they've been paying, so they still may pay out even if they have one or two bad quarters. So in that case, you're actually borrowing money from somewhere else to pay the dividend, because if you don't have a profit, obviously you're paying it from your revenues or other stuff. Some people will actually acquire debt to pay dividends. The typical yield is around 1 to 4%. There are companies who pay lower, like Visa, or I think even Amazon. And then there are companies who pay higher. Think of a utility company or some type of REIT or some type of, there's other specialized investments where they have to pay out most of their profit in a dividend. So let's go on to the next slide. So here I broke it out into two sides. Dividends, the non-dividend folks versus the dividend folks. And here, the non-dividend folks will say, hey, a dividend is just taking money away from the books. And that is true. And on the other side, the dividend says, hey, you know what? If you buy companies with dividends, they're generally more stable businesses. Because they're paying it from a profit, that means you're only investing in profitable companies that generally been around for more than 10, 15, or 20 years. You're not going to often buy a company that's been around for 1 year that pays a dividend. So that's their belief. Non-dividend folks say, hey, but aren't the total returns lower? Right? Because if you pay a dividend and you add that to the actual underlying return of the stock, does the two combined is still outperform, let's say, a growth stock? So that's the classic growth versus value investor. And they argue this all the time too. Now, a dividend believer also says, hey, but the increasing dividend will outperform over time, and some companies will pay a dividend increase that is above inflation. And so therefore, if you hold the stock long enough, you can eventually compute the yield on cost, and then you can see how big the dividend payments are, and there's a compounding effect, and this is why you're going to beat the market. And some of it is true, but we're going to address some of that other stuff too. The non-dividend folks say, well, that's wonderful, but don't that require you to pick the actual stock? And stock picking is always a hard task. Everybody knows in the world of stock picking, most people will underperform the index. So the non-dividend folks should be a believer in, why not just buy a low-cost ETF that tracks the S&P 500 or track the total market, because it removes this concept of stock picking. Because even in stock picking, if you pick a wrong stock, you can underperform. So there is some valid argument to this also. Now on the other side, they're like, oh, well, don't worry about it. It's actually kind of easy to do. This stuff is easy. The dividend's easy. It's passive in nature. And then to counter what I just said, there are high yield dividend ETFs, and there are many different flavors of dividend ETFs today. So later on, I will try to show you some of that. Now, the other side of this argument, people say, well, dividends should not be a factor in anything. I don't pick a stock for the dividend. I don't pick it for the dividend yield. I don't pick it for the future dividends, because dividends don't make a stock good or bad as an underlying factor. More about, is your business good? Is it growing? Right? A dividend is generally a byproduct of something else. So that's normally their argument. Dividend investors obviously believe time in the market. They don't believe in timing the market. They believe that if you buy dividend stock that will be around, that will grow and increase its dividend over time, you'll win. There's an argument over taxes. Dividend can be taxed more favorably, but Non-dividend folks say, well, tax doesn't really matter. You're still misconstruing it. What if this is done in a Roth account or whatever, right? So there are many other factors to look at in taxes. Now, the non-dividend folks will say, well, we can control your taxes actually a lot better. Dividends, you don't control the timing of it. It comes out on a fixed period every quarter or maybe twice a year or once a year like Disney. So depending on what stock you hold, you don't really time when it comes out. But the capital loss or gain, it's an event that's triggered by the investor. Whenever they sell, they can trigger the event. So obviously non-dividend folks believe that, you can control your taxes better because you control how you do the trade. Non-dividend folks are really saying, hey, we can control it better. Dividend people say, you know what? We buy it because taxes are better. Sometimes when you make under low income. So it is true in a lower income situation, you may pay less taxes. And in America, I think it was like $48,000. Your capital gains can actually be zero. I think it was under about 70 or 80 grand where your dividend can actually be taxed at a 0% rate. But I don't remember exact. I mean, you can Google it. So let's move on to some other things to think about. So what we're going to do is, in order to make this comparison fair, we're going to look at different things. We're going to look at assuming that non-dividend folks are really using the benchmark. The industry benchmark is the S&P 500, but you can also use the total market return, like a VTSAX. On the dividend believer side, we can do this many ways. There are people who are DGI investors, which is dividend growth investors, but I also want to look at some of the standard dividend ETFs, like an SDY, a DVY, or an SCHD, and then we'll walk through some examples. So let's go to Yahoo. We got this page up. We're gonna do this. So let's go and let's do our first comparison. So if you just do something like this, type in the word dividend, you're gonna see there's some really common dividends. So let's just take a look at one of them. Let's take a look at this one, a DIG, dividend appreciation. You look at the charts. This 5-year looks pretty good. 1 year looks pretty good. But it doesn't mean anything until you have something to compare it to. So let's just drop this. We're going to compare it to. Here you go. So you see in this one, look at this comparison. Pretty close. So the dividend one, actually it's pretty close. But what's the yield on this one? So let's back up of this. The yield on this is 1.48, which actually looks strikingly close to the S&P 500. Look, 1.30. Because this matters, because I'm going to show you something else that's very interesting. Now that you compare this one, the appreciation index, let's pick a different one. Let's pick this Vanguard high yield one. And then let's do this, full screen. And what's my point here? If you're comparing this to the S&P, let's zoom in. So on a short time frame, 6 months, and then you start zooming out. So on a 2-year comparison, who wins? The S&P 500 wins by a pretty big margin, nearly double the performance, 22% return versus 45. 5-year, I would expect this to get wider. So your dividend ETF is underperforming, and it's not by a little, it's actually by a lot. When you look at this difference, 106% return versus 49% return. Again, double your performance. You can add up all the dividends, even if your yield is, right, if you divide it by this time frame of 5 years, you're not capturing 50%. Now, it's a little bit hard to compare apples to apples because if you reinvest it, you're actually getting more shares. But the same can be true about the S&P 500. You're getting more shares. Again, so it's hard to compare apples to apples. But even if you did some simple math and say your yield was 4%, so if you did like 4 times 5 and then add some compounding interest on it, that will only bring you up to about 32% extra. So even with a reinvested dividend, you may get somewhere like 72 or 74%. But then you got to do the same factor with this one. The S&P 500 has a dividend that we're not reinvesting. So that would actually be a little bit higher. Maybe it's 110. Well, actually over 5 years, it may be a little bit higher. But again, you see how hard this gets to compare. But for argument's sake, let's just scroll out past the 5 year and look at this. The differences increase as time increases. So this is about a 7 year, 7 or 8, 9 years. But look, let's keep on scrolling out and look at this. These numbers just get wider. So I think you can see what I'm trying to get at. And this particular yield for this dividend one is, oh, it doesn't say. But let's pick a different one so you know that I'm not cheating. This is not some selective bias here. We're going to select this one here, the Charles Schwab dividend. This is a 2.89, which is about twice the dividend yield as the current SPY. But if you look at it from a short-term perspective, 2 years, S&P-Y is winning. There is a 2% yield difference, right? 2 point something. You add that in. You can see that in this case, it is possible that if you add that to this, the dividend actually may actually outperform. But if you go to the 5 year, you see that? The 5 year plus your 2 or 3% dividend over 5 year, that's a 15% point. You're still falling behind, but not by much. So this fund is actually much better, more solid. But let's just scroll out and see. But you see, it's still 7 years. You see that? Or 8 years. It's still a 40-point difference. Again, if you reinvest the dividend, maybe it's a little bit closer. But you see the pattern here. Very few things actually beat the S&P 500 benchmark. Let's pick another one. Let's pick something like. Hang on one second. HD. So let's pick this one here, the S&P High Dividend ETFs. Again, let's try to do a fair comparison. You're comparing the SPY. We'll start with a 1 year chart, 2 year chart. Here you go. There's a huge difference between the 2 year from a high dividend yield one. 5 year, I expect it to get wider. You see, anything with a higher dividend yield, it's going to underperform in the underlying of the shares. And the same is true if you just scroll this out. You see that this one's probably a 4% yield. It doesn't show me here, but I'm sure this one has a higher yield. And this is why the underperformance on the underlying stock is a little bit greater. So that's the argument here. So let's look at another classic one. Realty Income is a monthly dividend payer. Classic by a lot of investors. Look at the 1 year chart. S&P is going to outperform. 2 year chart. Look at that, 45% difference. Even if you add up your dividends, you're going to underperform. 5 year chart. Now this difference is huge. It's an 80% difference. And if you just scroll back out, you'll see this. And look. Now, I don't know that an anomaly, but you see there is a little crossover point here where the O actually did outperform. But then I think if you timed it perfectly, maybe buying it right here, you see even that didn't work. It seemed like there's one condition where, look, I'm going all the way back here. It seemed like if I go right here to right around 2000, that may be the perfect time where it outperformed. You see that? So it outperformed if you got in here. But again, it's a small window to outperform because you see that? If you got in 2003 and started dollar cost averaging, you may have underperformed the market. So be really careful of how you look at the data. You got to look at the charts and just see what happens. And this dividend is 4% a year. 4% a year. So let's just keep that in mind. Now, dividends are dynamic. They're not always going to be 4%. But if you do this 5 years window and assume it was a 4% yield for each year, and this is 5 years, so that's 4 times 5 is 20%. And if I'll give a little bit extra for compounding effect, let's assume it's 24%. If you add the 24% back in, that will bring you maybe closer to a 27, 28, maybe 50% return rate, even if there was some compounding effect. Again, really hard to do using a graph. This is a linear comparison without factoring a true dividend reinvestment during all these times when it was cheap and then a little bit less when it's up here and a little bit more. The only way to really do that is, right, if you had an account and you compared it. But you can see, even if you were up here at 50%, you're underperforming the S&P 500. Now, are there dividend stocks that outperform? Absolutely. Let's take one look at, I hope Pepsi outperform. I don't know, but let's take one look at it. Here's Pepsi in blue. So in a 1-year chart, it's underperforming by about 6%. 2-year chart is underperforming. 5-year chart looked like it was underperforming. Let's just manually scroll out. You see that even in a 7 or 8-year chart, it underperformed. And I think, again, this is one of the conditions where, depending on what year you got in, it may have outperformed under a certain condition. Like here you go. You see this certain condition? Pepsi outperformed right here. If you got in right around 99, 2000, you outperform. If you got in right here, and then look, 2001, it's close and it's not. So a lot of it depends on when you got in. But look at that. After that, you're going to underperform. You see that? Relatively speaking, if you got in 2009, 10. So this is why data is really hard to compare. You just can't look at one chart and say, look, Pepsi outperformed. But if you got in at 1990, right, 1984. So can dividend investor outperform? Well, it looked like in the last 10 years, Pepsi, even 15 to 20 years, very hard to outperform. Pepsi may not have done it even with its 2% yield. Now, I happen to be an investor in NEE. So I do know NEE has done really well as a dividend investing or a stock picker. So here you go. On a 1-year chart, doesn't look so good. On a 2-year chart, you see how close it is? NEE is really close. 5-year chart, and NEE outperformed the S&P 500 by a pretty big margin. And if you factor in dividends, you will see that this will even farly outperform. And let's just manually scroll this. You see this? Using the same comparison time as all the other ones from 2013, NEE outperformed. So this is a dividend stock that has outperformed. So I happen to own this, and I know that NEE generally outperformed the S&P 500 in most years. So if you're outperforming it every year, doesn't matter if you look at the year, 1 year, right, 2-year chart. For each year, if it outperformed, the difference will compound over time. But I wanted to show you this because if you can just zoom out of this, you will see that if I got in even before here, you see the difference is greater. But what we're learning is that's the argument that most people say. DGI investors or dividend investors are required to pick winners, and not every stock they pick is a winner. Then what are the odds of the average person beating it? And that's really the big question. It's a fair question. Because if it's just an outlier, if everybody in the dividend community doesn't perform better than the S&P 500 and let's just assume it's only like 40% people do, then the strategy is not a valid strategy where most people will have the average result that will beat the S&P 500. Because you're underperforming the S&P 500, it almost makes no sense to invest in anything else. Remember, as investors, you got to look at this objectively. You don't buy lottery tickets saying I can make $1 million or $100 million or $500 million when the odds or the rate of return are so small that even over time it doesn't make sense. Stock picking should be very similar in this concept of not everybody can duplicate the success. It's only a few outliers that do. And again, this is what I want to show you because let's pick a different company. Let's try 3M. Great company. Did it outperform? Let's take a look in the 2-year chart. The answer is no. So dividend investors got in 2 years ago. How are you going to outperform? 5-year chart. Underperform. Let's keep scrolling back. Look at this. This is a huge underperformance by 120% over the last 7-8 years. So even with all your dividends, what use is the dividend if your total rate of return underperform the benchmark? So let's just keep on scrolling out to see if this blue line may have ever crossed And look, you can start scrolling out. So far I haven't. It seemed like, you see this? Free M may have outperformed from here. And then look, all that is useless, because if you nitpick your graph and then sold it here and say, well, if I was 65 and I sold it, well, that's wonderful if that was you. But if you're my age, you're still holding the bag, because look, it went down and now it's underperforming, right? Because it's possible if I got in at 2017 or 16, I could have outperformed a little bit. But if I'm still 15 years away from retirement, then this chart is it's not convincing me that I outperform. It's telling me I underperform. So hopefully you got a better glance of what I'm trying to say. And let me sum it to you in this way. I started off as a dividend investor back in the days when commission was super expensive, and it made sense to invest using a strategy where commissions was not going to eat up the money that I put in. And I remember that. I started off using something that was low cost, free to accumulate the shares. It was ACH, auto debited once a month. I paid no commission. Some of them were a little bit, some of them were $1 each transaction. But this is in the days where I used to pay $200 or $300 or $400 on a stock trade. So you heard me right. I was trading when commission was $200 or $300 in one direction. And a lot of it depends on the size and how many shares you bought. And that's what it was. And I paid those commissions, and it was very hard to trade. You couldn't trade and then on a nickel profit sell the 100 shares, because when you factor in the commission, 100 shares come a nickel profit. It's not enough to cover the commission for me to trade and make a profit. So this dividend concept worked really well during the dot-com bust. When dot-com companies failed, my dividend companies were still around. They were still growing. They were still paying dividends for the most part. Some of them probably didn't do so well. When you look at history and you track this over 20 or 30 years, I did notice that there are many things that I held that were underperformers, including a free M that I showed you. But I also own Coca-Cola and Sara Lee and a whole bunch of other classic dividend stocks. And not all of them beat the market. Sure, there are Abbott Labs of the world. I actually own Pfizer, and Pfizer didn't do well. Now, Pfizer is turning the corner. In the last year, or even the last couple months, Pfizer may have done really well, and who knows where Pfizer is going to end. So I can't even tell you that Pfizer has been a great investment for me. Because I remember the peak was close to 1999 or even the year 2000. And Pfizer has not traded in the $50 range until literally last year. So it took 20 years to get back on there. Now, it does mean that your dividends were reinvesting at a low rate. So the story is not finished being told on Pfizer yet. The day I retire or when I'm cashing it out, I will do the analysis and see, did I outperform or did I underperform the S&P 500? So the question is, will I do this again? If I had to go back in time, will I do it again? And the answer is no. Because I underperformed a typical benchmark that anybody could have bought. Any user could invest it in. And especially today with low-cost investing in index funds or ETFs, anybody can buy a VTI, VOO, SPY, QQQ, or things of similar nature. And to get a decent market rate of return is pretty easy today. And to say anybody can pick a portfolio, because most dividend growth investors, the DGI investors, they teach you to construct your own portfolio by buying 15 or 20 or 30 different dividend paying companies. And to say that you're going to pick all 30 of these companies to outperform the market is not as easy as you think. So I still lean towards using a SPY index fund. And that's what I do now with all my new money in my 401k plan. They go into growth stocks, or I'm sorry, I said that wrong. They go into like an S&P 500 if that's my choice. If I have a total market choice, I'll pick that. If they have some type of growth and income ETF, I will pick something like that. I don't put my money in bonds. I don't put my money in value type ETFs. So my opinion is, in order for a strategy to be recognized as something that is doable, it needs to be replicatable by every person who listens, and the results need to be similar. You got to take the average of everyone following your strategy. So if my strategy is, hey, buy dividend investing stocks and outperform, if the 1,000 people in the U.S. did it, you got to take their average return of all the thousands, and then if you have 1,000 indexers and they all bought the S&P 500 index, it's easy to say, well, the average of those indexes roughly got exactly the same return because they all bought a similar index. But the averages on the dividend DGI method, you're going to have outliers on the bottom who underperform and got close to 0% return. You're going to have a whole bunch that sort of maybe mirror the market. I doubt it. And then you're going to get a few that then outperform the market. And if you take the average, my guess is most of them will probably underperform the benchmark. And that's my experience. Like I said, I've done it. My dividend portfolio is really not doing that well. Now, I like it now because I'm older. I'm close to retirement. I'm not chasing yields. I don't need a 10 or 12 or 13% rate of return. I'm okay with getting 7% rate of return. But in my 20s and 30s, I should not be getting a 6 or 7 or 8% rate of return. I would have been much happier getting the S&P average. And this is why these are the things that you need to consider in your thinking. Most people know that. You can't just use the outlier or some random effect and say, hey, this is how you're going to outperform. If the masses can't do it, then it's not a good way to measure it. This concept, if it's simple, needs to be doable by everyone. This is the reason why not everybody can pick penny stocks and make a lot of money. The same reason why not every options trader is a millionaire or billionaire. Because while there are a few people who can win playing those complex investment strategy, the majority of people actually end up losing money or barely breaking even or even barely keeping up with the S&P 500 return. So these are the things that you have to consider. Now, you may not like what I say, and that's okay. I want you to go and research it, maybe look at the math, study it out, Google it. Try to find other studies of other dividend investors who, if they say they can constantly beat it, or show me an index fund that's a dividend index fund that can constantly beat it. Now, there are other factors to consider. If you're retired, most people want a predictable fixed income. So there's a different usage of the dividend ETFs at that point. There are people who try to live off dividends. So at that point, they're not chasing 8, 9, 10, 12% returns a year. What they do is it's almost like use this 4% dividend yield. All they need is their portfolio needs to generate about a 4% rate of return. And what the investor does is live off of those dividends. So they're using an income producing strategy to retire, so they never have to do a drawdown or sell their principal underlying holding. They never have to sell shares in their investment. But that's a totally different usage. They're not chasing yield. They're just trying to live off of their dividend, and they're also not trying to outperform the market. So that's a different thing, different topic. Is it useful? Yes, you can do that. But there's still a better way to do it, because if you're retired with a $3 million portfolio, I still don't think you want to put all $3 million into a dividend ETF, right? What may be smarter is you still want a piece of it in growth, something that will grow at the rate of the market, because the market returns about 10%. You want one piece of it maybe in something like a dividend ETF where you can live off of a 4% yield. But this is the thing that you have to do from a retirement perspective. There are a lot of ways to set it up. But again, this is just one video to show you some of my ideas and why do dividends matter. It's not that they don't matter, but can you outperform the market? Can you get market rate of return? I just think there's enough data to suggest that investing in the S&P 500 is such a great strategy. Right? We all know active managers can't beat it, but I also believe that even a DGI investor or somebody who's using a passive dividend strategy is also really, I don't know, is it the best way? I would still prefer using the S&P 500 indexing. So comment below. If you don't agree, then explain why. Maybe give me a link to a study, or I'll be interested in reading up on it. Again, I'm not trying to say there's one way to do this. You can investing, you can do any way you want, but this is just my view. Not only that, it's my experience. I can tell you one thing: the last 10 years have been, obviously, the S&P 500 have really crushed the market. Now, will this hold true for the next 10 years or 20 years? I don't know. The S&P index constantly changes, and today, the way the index is structured, it's very tech heavy. So it is very hard to outperform and outbeat that using a dividend strategy, unless your dividend strategy is now all like an SMH type thing, right, with semiconductors or something. Anyway, comment below. Let me know what you're thinking. Let's do this together. Let's do this $1 at a time. As always, have a profitable day. Bye-bye.